Constantine Korologos. Everyone knows me as Tino, and I am a clinical assistant professor with NYU's Shack Real Estate program. I've had the privilege to be a professor both as an adjunct and now as a full-time clinical professor for close to 27 years now. And I'm honored to be able to present on a topic today with two professional colleagues and friends who are very experienced and knowledgeable in the industry, particularly around risk management and models. Our third speaker, Sabeth Sadiq, he is going to be joining shortly. He is the Chief Risk Officer for Butterfield Bank out of Bermuda. So he is now in Bermuda, not dealing with the snow and weather that we're dealing with in New York. But anyway, let's get started. So the idea today is to get my PowerPoint to work properly. We're going to talk about, kind of have everyone introduce themselves. We're going to talk a little bit about risk and uncertainty, and then about what a model is and how we know if it's working. And then, even though I put some bullet points down around model risk management, regulatory risk, and ESG and risk management, it's going to be a little bit more free-flowing. So please take advantage of the opportunity to put some questions into the Q&A box, and we'll try to get to them either during the presentation or toward the end. Definitely appreciate the participation from everyone. So with that, I'll introduce William Janis. William, if you can just give everyone a background on yourself, and then we'll get into the discussion.
Thank you, Tino. I am currently an adjunct professor at Fordham, Baruch, and Metropolitan College, and I'm also an expert witness for the Bates Group on securities litigation and broker-dealer regulation, and I lecture periodically for the U.S. Army War College on issues with respect to non-traditional threats in the 21st century. I was also a securities regulator at FINRA, the NYSE, for many years. And I had the privilege to serve on the faculty of the School of Professional Studies at NYU for about 18 years as well. It's a pleasure to be here. Thank you.
Thanks, William. And then Sabeth, who hopefully will be joining us shortly. Sabeth and I had the privilege of working together, or I had the privilege of working with him at Deloitte when he joined from the Federal Reserve. And when he joins us, he'll be able to speak a little bit more about what he's done, as well as his current role as a chief risk officer for a bank. So look, there's no question, and with every presentation, every article, every webinar that we get on nowadays, it's all about the pandemic, about models, about what is the data telling us, right? If you think about going back to March, we think about every day, every news channel was talking about what the models were saying about infection rate, about the number of deaths that we might experience, about the impact of staying in and slowing and bending the curve down. So models have even come even more so into the forefront of everyone's life. Yogi Berra, and for those of you of a younger vintage, a famous New York Yankee baseball player, as well as former manager for the New York Mets. He always has some great quotes, and I kind of thought this one was appropriate. If you don't know where you're going, you'll end up someplace else. And when you think about where we've been with regard to the market conditions over the last going on 12 months now, if you think about it, it's almost a year. Looking at what the data is telling us, looking at risk, and trying to really understand it in the context of a change in the rules is something that becomes very relevant because we can't afford to be wrong if all we're doing is looking in the rearview mirror. So I thought I'd put out a couple of definitions just for clarity and distinction. So when you think about risk, it's decision-making situations where there is a series of potential outcomes, right? You can have good returns, you can have moderate returns, you could have significant losses, and everywhere in between. And risk is really about determining the likelihood, the probability of those occurring, so you could figure out what's your expected risk for a particular investment. Uncertainty, what's missing as compared to the definition of risk is the probabilities and even what the outcomes might be are still very uncertain. And if you think about how many people are going to go back to working in their offices as opposed to how much of a change will there be in work from home, how many people are going to go back and shop the way they did before versus continue to do what they've been doing with shopping online. So all these things are really still some level of uncertainty. And then the last definition I put here is the concept of value at risk, and William will speak a little bit more to it as well. It's a financial metric that estimates the risk of an investment. If you picture a normal distribution curve and you want to say, what's the value of the 5% of this distribution of the overall investment that I have? If I have a 5% loss to my investment, 5% exposure, what is that risk level going to look like? So it's evolving, and in particular, it's evolving around climate risk. So William, I'm going to stop for a second, and I know a lot of the stuff that you do on the consulting side also involves dealing with VAR. So maybe you could kind of put your comments into that as well.
Yeah, no, it's an interesting thing because value at risk really got discredited in the financial crisis. And there was a lead up to the financial crisis. There was a regulatory initiative that the SEC and the international regulators had come to an agreement on. There's this idea of consolidated supervised entities to satisfy the European Union's concerns about having fragmented regulatory structure over their financial services firms. So the concept of CSEs was used, and there were 6 or 7 large firms, including JP Morgan, Merrill Lynch, and then Lehman Brothers, rest in peace, and Bear Stearns, right, rest in peace. So value at risk was a concept that was integrated into the capital computation and the financial integrity processes of large investment banking firms, as opposed to the very, very granular basis that under the Federal Securities or Securities Exchange 34, which is essentially a quantum-driven requirement that a firm has to have a certain amount of net capital depending upon the kind of business it does. In this case, the large firms were able to use this concept of tentative net capital with these bands that the markets could move up and down, and they could still not necessarily be out of capital compliance, subject to using value at risk. One of the issues is that the people that were developing VAR for the last 25 years leading up to the credit crisis came of age in the early mid-'80s. So if you're like Professor Tino and I, he's gray hair and I'm no hair, a generation before that was much used to economic dislocation, right? We had a phenomenal bull market from 82 to 2000. We had a horrible bear market from 64 to 2000, to give you a little bit of a historical perspective. So VAR was somewhat discredited with the credit crisis. It's come back in vogue. And now with the concerns about climate change and stranded assets, and then the impact on environmental, ecological, and biodiversity security, there have been a reformulation of VAR to address green VAR or climate VAR with respect to climate change. And those are some of the things that are going on, trying to factor in the risk of decarbonization, stranded assets, lost assets. And broadly speaking, internationally, you have a coalition of central banks that make up what is called the network for greening the financial system. And the central banks here, and even the Biden administration, is seeking to tweak the mandate of the Federal Reserve to address climate risk. And it's an interesting, evolving topic.
You definitely see, I know, other than the fact that I can't even count how many emails a day come in for some discussion about the impact of COVID, and whether it's a webinar or an article. But what I've definitely noticed is over the last, particularly probably the last 12 months, the number of emails and articles that are clearly pointing to the discussion on ESG in real estate. It is something that I think as an industry, we probably were in totality a little behind some of the other sectors. And now it's clearly something that is starting to receive a lot more focus. So, and I think along those lines, all the discussion today, even though it might be more general, broader financial markets, think of it in the context of real estate investments, right? So when we talk about what a model is, the Federal Reserve has a definition in their guidance on what they define a model to be, a quantitative method, system, or approach that uses statistical, economic, financial, mathematical theories. And it consists of information, the input part, the processing part, and then the reporting part. So when I did have an opportunity to work with Sabeth at Deloitte, one of the things that we were very involved in is supporting banks on helping them understand and create models to stress test their portfolio in order to meet the Federal Reserve requirements for capital adequacy for the banks. And the guidance was put out, but really understanding how do you put that model, how do you create that model was less clear. So if you think about those of you working in the industry, how many models you have on your computer, whether it be, small Excel models or complicated Excel models. We're using it all the time in financial analysis, even if it's, an Argus model that we might be using. And we take for granted that the model is accurate, that it's doing what we want it to be doing. And under the Federal Reserve guidelines for models and model risk management, it's not just that you have something you think it's working. It has to be tested. It has to be back tested. There's a separate group that has to verify that the models are valid. As a result of the financial crisis, the Fed created the requirement to have independent model validation, so that people independent of the groups that are using the models have validated the models. And then the other thing that we take for granted is that they're documented, right? That if someone who created the model leaves the institution, does someone else know how to pick it up and use it, because it's completely documented to tell you exactly what it does, what you need to do to it, what the output is supposed to be telling you. And we don't necessarily, again, these are things we take for granted. And I would make the argument, and William, please, share your thoughts as well, that models that were in place, particularly with real estate, but all financial sectors, up to, call it, February, March of last year, had history that were the basis for those models. And then we jump forward to post-pandemic or into the pandemic, and that a lot of the things changed. During the global financial crisis, I had the opportunity to go and travel for, even with some of these bank projects, supporting banks in their in creating stress test models. And I remember going to Vegas for a bank project, and during the financial crisis, people were still there. There weren't as many. They may not have been gambling as much. The hotel rooms might have been cheaper. The shopping might not have been as great, but they were there. This is completely different. This is no one was there. And I don't know if models were robust enough to be able to capture that kind of impact that we experienced.
It's an interesting thing that you mentioned about the model and the validation, because around the time FASB came out with Pronouncement 157, which spoke about the validation and the recognition of three tiers, right? Companies and assets that are based upon a publicly traded price, so that's equities, and then you have the second level 2 asset, which there is a pricing model, quantitative pricing model, and then level 3, which there's really no discernible model or anything that can capture it. And there was the level 3 assets on the FASB 157 that really constituted what the troubled asset relief program was about, the TARP, and it was calculated to be $750 billion. That's what the level 3 assets, I think, was out in the public domain, a guesstimate. An interesting thing is that the evolution from asset financial wherewithal, right, to say, all right, we have good capital, good assets, now has evolved to more liquidity. So you go from net capital, which is obviously integral to broker dealers and banks, from that to TLAC and CCAR, right? The highest levels, the boards now have to be involved. And there's much more concern about not only stress testing an individual's position, right, but stress testing across the entire firm, right? For example, we just saw with I call it GameStop, not GameStop, because I think there's the company and then there's the stock market that took place. When you talk about margin, right, if at one time you would talk about a strategy-based, a position-based requirement, 50% Reg T, and then you went to portfolio margin, and you're looking at a diversified portfolios, and the idea of stress testing an entire firm's liability exposure if everyone had a margin call, right? And if a brokerage firm, everyone had a margin call, ultimately, they'd have to take a charge to their capital. And that's exactly, I'm speculating, but I think that's probably what happened with the latest case there with GameStop and Robinhood and all the players that were involved. So it certainly has evolved. On a macro picture, it's an interesting thing. There's the law of unintended effects. So with Basel 1, 2, and I think we're in the world of Basel 3 now in terms of liquidity requirements, it really put a premium on liquid securities, and U.S. Treasury market is the biggest in the world. And there was a book written called The Dollar Trap, right, by I think Arvind Subramanian, who had been an IMF chief economist. And essentially, some people speculate that Dodd-Frank and all the credit crisis reform have essentially really reinforced the position of the US dollar as a reserve currency and has essentially created this tremendous demand that has driven down the prices and help keep interest rates a little low. I mean, during the financial crisis in 2008, in October of 2008, you actually had negative yields on the U.S. Treasuries. I think it might have been the 10-year, but so you had negative yields while we're in the middle of a financial crisis, because ultimately there was a flight to quality.
William, you bring up some just great points about this, the liquidity and even just how effectively how models can move the market independent of what might be the true value of the collateral that you're working with. There's been some good comments coming in the Q&A, and I apologize for not being able to respond and then still be facing this. So if you do have more detailed questions, we'll have some questions at the end, but also please feel free to reach out after. And I know, you know, some of the comments really talking about kind of the reality of some of these statistical models, right? And whether some of the models are set up to be kind of self-fulfilling prophecies that you create these models and it kind of gives you the answer. It's got that model bias to it that gives you the answer that you think is the answer you should be getting, but maybe the model is actually leaning you that way because you kind of either directly or indirectly told it to bring you there.
Well, I think it's like the issue, like they call it with the quantitative traits, right? The quant quake that we had in 2007. If everyone has gone to the same business schools and has learned the same modeling, and the models come up essentially for the most part with the same result, and if the result is that you should sell and everyone's selling, there is no buying, it could cause dislocation and hiccups. And alternatively, a broad issue that came up this past year with the pandemic is that the quants now, right, post-credit crisis, you put a layer of machine learning and artificial intelligence to modeling. And the artificial intelligence, the modeling says, well, the market has dropped 7% and it's a good time to double down and buy up, right? And it kept on buying on the dips. And then when the market sold off in March of this past year, risk managers were so concerned that they essentially overrode their own models. And it was in retrospect, a historic time to really have bought at 18,000 with the market at 31,000 today.
Yeah.
So, there's a factor of behavioral science that I think is underestimated in this process.
And in one of the courses that I teach, one of the books that we use, and I know Professor Sanzo, who's on the call today, also uses it as well, is When Genius Failed. And I actually was working at Moody's when that all went down with long-term capital management. I remember being out to lunch with a colleague of mine, and there was another Moody's analyst who I didn't know, but he knew, sitting at a table a few tables over in the restaurant. And later on, I found out that he was the sovereign rating analyst for Russia and was going back after lunch to go and put the downgrade on Soviet debt, which of course was the second knockout punch that really did the most damage with long-term capital management. And when you live through that, you see, here's what happens when you are staring at the rearview mirror and really relying on everything behind you that is accurate and correct as the truth. And that works until it doesn't work anymore. And usually when it doesn't work anymore, it's a big noise that you hear when it doesn't work anymore. And that long-term capital was a perfect example of models that were relied upon without any overlay. You talked about risk managers saying, I know this is what the model is saying, but I don't want to go with that. I want to override that, because if I go with that, that might not take me in a good place.
It's funny that you bring up an interesting thing with long-term capital. So it took place around 1998, right? It was the summer of 1998. And it's a funny thing, in the 20th century, you look at the history of Russia, right? Under the Bolsheviks, they had debt was forgiven by the United States during World War II because of out of necessity. But under the Bolshevik communist regime, they never defaulted on their debt, right? So when they converted, or once the Soviet Union imploded and Western development agencies went there and people to try to usher them into more of a capitalist regime, is as when they actually defaulted. So I always teach my students that whenever you look at these titles here, Black Swan, White Swan, VAR, modern monetary theory, whatever, it's always good it's always vital to really understand historical context and what's going on with the world at the time, nations in general. Because I think if you just look at the numbers in a very narrow prism, it doesn't really give you the broadest perspective. It's just something to think about. I always tell students that have traded currency and foreign debt that if they knew anything about history, they could have made some money during the sovereign debt crisis in 2012, because when Greece was on the precipice, was defaulting, I mean, it was essentially a passive aggressive default. What did Greece do, right? They got invited by Russia to go there, and Russia was willing to bail them out, right? And the historical relationship of them being Eastern Orthodox countries, and the Tsar being the protector of Christianity, and Moscow being Russia being the third Rome. And once those dynamics took place, since it was a NATO country and the Russians wanted naval bases there, the US and everyone else was going to pony up a little bit and ensure that we work out a solution. So I was telling students, it never hurts to know a little history once in a while. You can actually profit by it. It's not something that should be reserved for quiet reading on the beach sometimes.
A comment came in from another professor regarding the models that were being created kind of early spring of last year, trying to look at the pandemic data, and that the models were constantly being updated based on what the historical data was. And Ryan brings up a great point in his comment question is, aren't you, like, all you're doing by adding new data is just adjusting your model to reflect the past, whatever the data is telling you, the rearview mirror, and not necessarily what about tomorrow? How, the data from the last 11, 12 months regarding, let's say, office space and utilization and demand and risk and, the impact of work from home, there's some information there. But if you look at the statistics and the numbers, and then you say, okay, I'm sitting today, February 17th, 2021, looking forward, and I have a portfolio of investments that include office. Do I just use the last 11 months of data to drive my forward-thinking views? Or do I say, thank you very much for your historical data, but now I have to make the call as the investor. How much of that do I consider, and how much do I overlay my qualitative views on what I think? Because if you wait for all the data to be out there, for every company to say, we're going 80% in person, 20% work from home, or whatever the numbers are, by the time you do that, you've missed either opportunities or the opportunity to hedge and protect what you owned already, because it's too late. You waited for the market to tell you what it thinks, and you didn't put your view in, and now you missed it. You missed out. So we talk about VAR, and we talk about the swans, right? So the Black Swan, which is also a book we use in our classes. I think that Taleb he viewed the pandemic as not a Black Swan event, and I
quite agree.
I agree with him because, and I think in the next bullet point, he actually said it was a white swan, where it was something that was almost certain to occur at some point, and therefore it wasn't a Black Swan event. Now, whether people included it in their probabilities of what might happen going forward, I think we know what the evidence says on that. Most people didn't, but this idea that when you just don't know that something's going to happen, it's not in the realm a possibility. I think it's really hard with the definition of Black Swan to have, I mean, to really have one. I mean, it really has to hit a threshold where this was not expected and no one knew how bad it was going to be when it happened, right? So we had that kind of show up as as reasoning behind what we've observed. But now, and William, I wasn't aware of the new swan until you brought it up the other evening we were speaking. This idea of the green swan.
Yeah, it's on the radar because of climate change, which is really changed, has really morphed into ecological change. And then you're talking about, as they talk about, biosphere change. And why I say these are important, right? When the Department of Defense is publishing research on climate and national security, right? When you're talking about the military is worried that its assets, right? Its bases have been flooded. It's losing assets. It's going to be called in to address maybe climate conflict, right? There was a sergeant a few years ago, special forces down in Niger, that was killed, right? Until he was killed, and most Americans didn't even know that there was a Niger. They only thought there was a Nigeria. So the Sahel region, sub-Saharan Africa, is really experiencing the negative impact of climate change, which has exacerbated, climate conflict. And you have Boko Haram, you have the Al-Shabaab, more in Kenya and East Africa, exploiting wildlife trafficking, selling, and they're just taking money, and they're also paying troops to further foment more issues. And also they could corrupt and subvert governments, right? Because they're siphoning off resources. So it's a broad, it is a big concern. And to me, green swan is, again, it's all out there. It's kind of, these are, you could say black, white, and green are really part of, the swan or the white swan, because essentially I think what happens is that in the financial crisis, there was kind of asymmetry of information or analysis. So with the black swan, you take a look from my Goldman, they were very active in 2008 on the credit default swap market with AIG and others, because they had prognosticated in 2007 that the real estate market would sell off, right? They did very rigorous back testing. And it was all out there in the public domain. Unfortunately, there was the issue with Paulson and the hedge fund. And other firms like Merrill, Lehman, and everyone doubled down on their bets. So I think that's one of the reasons why there was that financial hiccup. If you had, a level of analysis that could look at white swans with the same acumen, you probably wouldn't have the black swan, because essentially, like a fish in markets, right? There's money that moves into an area, it regresses to the norm, right? If you have a very illiquid, opaque market, and I'll call risks, in this case, a very opaque market or risk assessment. If it's very opaque and illiquid, the ones that get in first are the ones that benefit the most. And it's just an interesting dynamic how this stuff played out.
Getting back to the idea of these effects on, particularly on the real estate market now, students that are studying in the program are looking at, when I leave the program, there's an area of real estate that I'm interested in, and it's important for me to understand how that market and the rest of the markets around it are going to be working. And if I don't get at least the answer to how they might be working, at least I'm given the tools to think about how I can come up with an opinion about how they might be working. So the idea that we've had this, call it structural change in the real estate markets as a result of how space is used, how people shop in retail, what they look for when they stay in a hotel, and that dust really hasn't settled yet. It's probably not unreasonable to say that all the models that people have been using, at least to help guide them based on historic data, are either need to be retweaked or possibly created from scratch to reflect a significant change where all the relationships might not be the same as they were before. Your lens into the regulation at the company level and with your regulatory background, what are the companies doing now? I mean, we have you brought up another acronym that I wasn't aware of, this EESG, which I hadn't heard yet. So maybe I can impress people if I bring it up. But well, I forgot there are no cocktail parties anymore, so never mind. I hadn't heard that before. So
well, it's really a paradigm. ESG, like a lot of people view it really as enterprise risk management, right? Environmental, social governance. And the idea is if you get the governance right, then the social and the environmental will flow from it. Judge Leo Shrine, who retired from the Delaware Court Chancery, who spoke about the idea that, particularly now with the pandemic, is that with the social contract fraying in the United States and the public sector having limited resources, that you had to kind of expand it to include employees, right? So today there's the idea of stakeholder capitalism, right? The idea that if your employees are unhappy, the community around you is not prospering, the company's not going to prosper. So your employees are not only employee, shareholder, but they are certainly a stakeholder. And the idea that you have to have happy workers, right? And people that can make a meaningful living. Tied to that is an issue you raised, is that, like, if I was thinking about graduating now, what I would be focusing on data points in terms of a real estate career, well, I would be thinking about perhaps with the work from home, delivery model, right? The Amazons of the world are buying up more and more warehousing. So maybe warehousing might be, might be a sweet spot. They're talking about green steel, making green steel, right? Asia is the biggest producer of steel in the world, and that's obviously very, very fossil fuel carbon intensity. And then cement, right? They're talking about greening of cement, right? If you look at the footprint, fossil fuel footprint from steel and cement, so anyone who's thinking about a career now in development has to, I think, look at it through a kind of a somewhat green prism. So ESG is very, very important. And it ties in with two other broad issues. Let me just go to the prior slide, which you don't have to go, one other thing. So if I was thinking about the sweet spot in the area, all right, so ESG and green, then I have to think a little bit about financing. So there's this modern monetary theory, right, that, deficits don't matter, right? Remember what Sarah Palin said about oil, drill, baby, drill. Now it's print, baby, print, right, with money. Well, deficits historically do matter. And the world financial order is evolving. It has been an anomaly since 1945 or so, where the U.S. has really been the sole reserve currency. Prior to that, the interwar years from World War I through World War II, you had dual currency status, and you had the British pound sterling and the dollar. Very slowly but surely, China has incrementally internationalized its RMB. They've Asianized it. They have, like a lot of banks, they have a central bank digital currency platform and initiative, and they actually broke into the top 10 of foreign holding, people holding actually the RMB. And there's been a lot of money flowing into the Chinese bond market. And, you could look at that strategically, militarily, security, say, well, this may be a problem. But from a financial perspective, it might mean down the road, we won't be able to print money as much. We might have to raise interest rates. So if you're factoring in your internal rates of return on real estate, maybe the scenario planning is that if deficits go up and we have the inability to print and we have to raise rates to suck in a certain amount of money, and there is a lot of domestic money that could go in, what is my scenario planning if the 30-year goes up to 3% and went up from, I think, 0.8 to 1.8, right, in a span of 5 months. And even the 10-year went from 0.7 to, I think, 1.22 or 1.21 in that range. So I would be thinking about that. And then if you want to fast forward to the next slide, the idea that the ecological impact, right, zootonic, human-wildlife nexus, it's forecast that there are literally over 1 million or so unknown viruses in the wildlife and the ecology system that could impact hundreds of thousands of people. And as there's more climate change, land degradation, and things of that nature, the nexus, right, the zone of comfort, that nexus essentially is deteriorating, and the interaction is there. So I'm talking about, the UN and a lot of international agencies said that we might be coming into an era of, of pandemics, and I would be thinking about that. And the way to address it is through, the idea of an ESG focus, and try to model and structure my, career to take advantage of that. I would be thinking about, greenfield, green type of real estate development in a higher interest rate environment.
And regardless of whether you believe that there's enough data that supports the impact of our carbon footprint on the planet, and what the impact is to water levels rising, or because of damage that's being done, increasing the potential and the speed at which other illnesses like coronavirus, are spread, and the impact that they could have on people. Regardless of whether you believe that's the case now or not, what is happening is there is capital that is being allocated by institutional money managers, insurance companies, pension funds, that are looking for some sort of rating or score or standards around an ESG platform, program, strategy. And they're not going to give you capital, or you're not going to have access to that component of the capital unless you have something that is quantifiable, measured, and directed into those type of investments, more sustainable buildings, et cetera. So it is going to cost more money if you're not looking at investing, or at least having some strategy, because some of the capital is going to say, we're not going to give you money for that if you don't have some sort of plan in place. So it is going to affect real estate capital. The rating agencies are starting to look at not just an ESG score, but actually looking at, are there possible lower loss given defaults? Is the probability lower of a loss based on some sustainability model that is being used in those buildings? The loans that have some sort of ESG model, that have some sort of sustainability in place, that they perform better or have less loss, and therefore would receive the benefit of that. These things are real and happening now. And if you're going to be out in the market looking to develop, you're going to have to think about, what are the additional costs I'm going to have to include in my budget in order to include all the things that the market expects from a sustainability perspective, let's say.
Well, it's an interesting point, because I think that this year's very interesting year. And, you know, if I was, again, graduating or planning out my career, this is probably one of the most interesting years to take a step back and watch and let events unfold a little bit. So you have credit rating agencies that have obviously have integrated ESG into their ratings formulas. An interesting thing, because of the plethora of ESG hubs. I mean, at one time it was estimated that globally there were 500 and over 560 different ESG type of rating hubs that had come up with their own formula for ESG and sustainability. And BlackRock, given its size, has put its weight behind the TCFD and SASB. And then SASB is merging with the International Reporting Council, IIRC, right? So they should be, the merger I think takes place in 2021. So you're gonna probably see a little bit more congealing on some type of more uniformity with respect to ratings. An interesting thing that's going on is this open source data initiative with ESG. So the Goldmans, the Amazons of the world are part of a platform to create a base level of ESG for the average investor, retail, regulators, anyone to be able to look at, to be able to access, to say whether these firms are actually really talking the talk and not just, you know, walking the walk and not just talking the talk. So I think, you know, that's an, you know, an interesting thing. And then I think when you're talking about data, we're in a world of data, and you know everyone talks a lot about machine learning and artificial intelligence, and data governance is vital. So I think that if I was doing any modeling, or if I was in an organization and I would, you know, I was making budgets, I would be focusing on obviously, you know, good data governance, and not look at ESG in a very binary either or type of perspective that it's great, it's going to change the world, it's, you know, we're going to green. Think of green as really more like forest green, right? So an example is that in China for a long time, they used to consider green clean coal. So I'm not sure how, if coal by definition is clean, but they had a very, you know, generous definition on green. So I'd be keeping my tentacles up for those kind of developments.
Yeah, I just saw that Sabeth just joined in. I know that he's been, you know, as a chief risk officer, drinking from a fire hose. So,
Yeah.
James, we're about 10 minutes before the end of the hour for the presentation. So my thought was, to the extent people are willing to stay on, and I want to be mindful of people's time. So let's say an additional 10 minutes, then at least we'll have an opportunity to hear a little bit from Sabeth on, especially given his regulatory background on the market today. And then I can, so let's say go till 20 minutes to or a quarter to 2. So if James, if that would be okay, then this way we give an opportunity to Sabeth, and whoever is unable to stay on, the event's being recorded, and you'll be able to watch the additional.
That's your call. So if you want to extend it, that's great.
Okay, so if it's okay, why don't we do that? Sabeth, I see you muted, and we don't see you, so you can unmute and join us. That'd be great. So while I'm waiting for that, Janis, you've been putting in some great commentary and questions, and I apologize that I haven't been able to get to them live as we're going through this, but I do want to at least comment on your last question about what are the impacts of COVID, you know, work from home, decreased traveling, social consumption, et cetera, as a permanent influence on real estate, and how much of it will be transient. And I think realistically, from my perspective, that's kind of the $64,000 question. I don't know if we have enough to support a solid view of how many companies are going to say, here's how many people we're going to allow to work from home. Here's what our model is going to be and our strategy is going to be. How much of the retail consumption where people used to just go online during the last year and shop and buy so many more things than they did before, how many of those people are going to go back and modify what they shopped for online and go back to the old way of going to the stores once it's safer to, or people feel safer to do that. And I think that's where this is a structural shift that's different than what I think we experienced in the global financial crisis, which was purely, I would say, leverage, all about leverage and leverage on leverage on leverage. This is different. This is people not shopping. This is people not staying in hotels. This is people not going and working from their office. And how many of them come back and when? I think that's where you as a real estate professional, you as a real estate student looking to go forward, that's where you have to kind of layer on top your viewpoint, because I don't think that there's enough out there to really make that call yet. So Beth, I thank you for joining us. We spoke about, kind of the idea of the concept of models, the concept of risk, and some of the things that are really difficult to measure right now in the marketplace. And I was wondering maybe if you can give a quick background on what you've done before, particularly with the Fed and since then, and then maybe if you can comment on where, what do you think that the regulators are thinking about now in the context of where where we are with loans that have been pushed forward, where there's been modifications and forbearance, and what are the banks thinking about?
Okay. Thanks, Tino. Sorry, apologies everyone for being late. Yes, everyone has read about my backgrounds. I won't go on too long about that, but basically, banker most of my career, and then worked at the Fed in DC, where I was assistant director of banking supervision, particularly during the last financial crisis. Right now, I would say the federal banking regulators are focusing on the overall economy because that's what's going to drive the overall financial stability. And so one of the key things is making sure that the economy gets the liquidity it needs, the PPP programs and the small businesses getting loans. And so that's going to be a continued focus among the central bank, at least the Fed, on making sure that the economy comes back, because without the economy coming back, you're not going to have the overall financial stability, which is clearly a focus of the Fed. So the programs that they've introduced, and also to the extent that they can, allowing the banking system to make sure that the most needy people actually get the funds from the Biden program that they're talking about. So a key lesson learned from this recent crisis is that the banking infrastructure is not geared towards getting money to the most needy parts of the economy, but rather, the large corporates, the middle market companies that have well-established relationships with the banking community. They're the ones that actually had easy access to the tremendous liquidity that the Fed tried to inject. And so I think those are the two areas, immediate areas of focus from the regulatory side. And then on the other point that you mentioned, the Fed has come out with, I would say, I'll use the word forbearance given to borrowers that banks may feel are going through a temporary difficult period given COVID. And so, examiners are giving bank leeway into assessing whether it's a secular change in the borrower's ability to pay or whether it's actually a temporary blip in the borrower's able to pay. And that's going to help determine the appropriate level of TDRs, troubled debt restructurings, and non-accruals, and so forth. Perhaps many have seen that the largest banks have released their provisions at the end of fourth quarter. So there has been a large number of banks that have released quite a bit of provisions that suggests that the level of uncertainty that existed, 6 to 9 months ago, is not necessarily the case today. And the amount of provisions taken in amount of potential defaults that they were expecting has not come to fruition. And I think that's partly due to the forbearance given to the borrowers, and also partly due to the economy, segments of the economy being much more resilient than we thought it would be. And there are actually two economies: the sector that's highly automated, technical, that sector where the online working from home and the online commercial aspect of things have actually done better in this crisis. They have not been affected. The industries that require much more people contact, clearly have been affected. So it's a tale of two cities, if you will, and two economies, and that is not to diminish the tremendous hardships that is occurring and still occurring going forward, but the level of problem assets that we thought would be in place by now in the banking sector in general has not reached that level. I would say, however, that if the pandemic situation does not improve substantially within the next 6 to 9 months, we will likely see a rapid increase in defaults because the level of liquidity and working capital available on both medium and large corporates, I don't think they've got more than another 6 to 9 months. And so I think that if the economy doesn't turn around, you'll likely see defaults increasing in the second half. But given what's going on, it seems like the vaccine is having a positive impact so far, and hopefully things will turn around in the next 6 months or so.
Have you the questions that I have heard pertaining to the larger banks releasing some of the capital reserves that they had taken on, that some people are asking, is it premature? I know that there's less uncertainty now,
Mhm.
but is there enough certainty that can be quantified
Mhm.
that we're far enough out of the tornado that we're safe and it's okay to start releasing money. I don't know, maybe your tale of two cities, it almost feels like it doesn't feel like everything is better to the point where I'm not sweating anymore. But yet it seems like that's what the guidance or the permission has been of these larger institutions to release money. So that,
Yeah, I would say that if you look at the provision levels at the end of the fourth quarter, they are substantially higher than they were at the beginning of 2020, but they are meaningfully lower than what they initially thought the conditions would be. And so, yes, I would say we're not out of the woods yet, but I think it would not be unreasonable to suggest that we do see some light at the end of the tunnel. The likely default rate, so the likely rate of problem loans, will probably be not as bad as it was during the second half of 2020, given the resurgence of the economy, although somewhat anemic, and given the vaccine that is giving us hope. And so the assumption that is reasonable is that we're not out of the woods. The provision levels are still meaningfully higher than what they were at the beginning of 2020, but not as high as we thought or it needs to be, given the tremendous uncertainty during the during the second and third quarters of the pandemic. And so the view is the worst is over. And so therefore the levels do not have to reflect the worst levels that we've gone through. And that I don't think is an unreasonable assumption. And although one could argue that, and so there continues to be uncertainty going forward, and there is a distinct possibility that the economy may not come back. And so, but there's also a distinct possibility that we will come back. And so I think given the opportunity for the banks to release rather than hit their earnings even more, I think under reasonable assumptions, the banks generally have released.
A question with the Biden stimulus, right, of 1.9 trillion, and rates have gone up a little bit, and is that global story about zombie companies that should or otherwise would have defaulted. How do you see that impacting the scenario, even if we get out of the doldrums economic and the economy recovers? I mean, obviously there's been a disaggregation between the financial markets and the underlying economy. Do you think that the interest rate scenario, if it's long-term going to rise, would offset some of the efficacy of the economy recovering and mitigating defaults?
Yeah, I think so. The long-term rates, suggest in the 30-year side and 10, 30-year that it's going to rise, but the short term clearly is going to remain low, which means that in the immediate 6 to 12 months, there's going to be a requirement of a lot of fiscal assistance. And in that level of fiscal assistance suggested by the Biden government, there could be less clarity about the business models that will survive in the future versus the business models that won't. And so, as the interest rates rise, there could be defaults of institutions that survived during this pandemic environment, given the fiscal support that they've received. That is a distinct possibility, given the change in the landscape of the business models. And I listened to both of you earlier saying that the new normal may not be what we know of.
I just had a follow-up. You hear a lot about global dependency ratios and the new paradigm in the markets and justifying, I guess, a dividend bubble. Do you give a lot of credence to the idea of the graying of the world economy and having a bearish impact on rates long term?
Yeah, sorry, I couldn't hear you. Could you say that again?
I apologize. There's always a lot of talk about the global dependency ratios negatively or putting a bearish sentiment on interest rates and justifying high stock prices and high dividend or dividend bubbles. Do you give a lot of credence to that? Do you think that GDR is overblown, or do you think it's impactful in terms of the trajectory of interest rates, or just another element of the discussion?
Yeah, I think that right now there are pockets of frothiness, but is it completely frothy where you need a bubble to where there's a bubble, but the tremendous liquidity being injected into the process is causing some of these imbalances, and so going forward, the balance sheet of the Fed has to decrease. Otherwise, you'll have these kinds of imbalances that you're seeing. In terms of the interest rate, it's still going to be historically low. I mean, we're near zero right now, and over the next 3 to 4 years, interest rates will increase maybe by another 300 basis points to 400 basis points, which from a historical perspective is still relatively low. And so interest rates having a significant impact on many companies, to me, doesn't seem like a significant risk, other than for those companies and consumers that are already very highly levered, and so that kind of jump over time will affect them, but so that's the riskier side of the spectrum of borrowers. But overall, and that represents probably 20%, 10 to 15, 20% that would be subjected to that type of risk. So the 80%, the bulk of it, I don't think is going to have a huge impact by interest rates, but the liquidity that's injected into the market needs to be dealt with, because that's going to create inflationary issues as well as potential bubbles going forward if that is not corrected going forward.
Probably, especially if the money that's being pumped into the economy is not creating production that is going to grow the economy. If it just goes out there and then it kind of, someone used the term in the Q&A box earlier about kind of frozen money. If you just print frozen money and you don't put it out into the market and make something happen with that money, then all you're doing is building up a bill that we have to pay later on, but you're not supporting the economy that's going to be there to pay it back later on.
That's right. That's right. And so right now, all this liquidity injection is keeping up asset values, so that there isn't a mass depression that occurs. And so
I think you froze up a little bit. So Beth, I have one more. Oops.
A withdrawal of the liquidity out of the system, a steady withdrawal.
I have one more question I'd like to ask, and then we've gone over time, and I appreciate everyone for staying on, and we'll share the presentation for those who had to leave earlier. I saw the other day that the Fed had come out with their, I guess, 2021 scenarios for stress testing for the larger banks, and I know that they had come out with their 2020 scenario right before COVID kind of hit, and then they came up with a updated version in the fall that they had the banks go back and revisit. So I haven't looked at it yet. I don't know if you have, but do you think that the stresses that are in the 2021 scenarios are consistent with before, or have they kind of modified them down or softened severe a little bit?
Yeah, they've definitely softened the severe a little bit because, and that's in line with their decision to allow banks to buy back shares and continue paying dividends. So that is a decision that they reversed, that they clamped down and reversed based on the last stress test. So, there's nothing that has occurred that would suggest the Fed actually have scenarios that are more draconian than what they did in the end of the year. And so the latest set of scenarios is consistent with a more benign outlook, but clearly not out of the woods yet.
Yeah. So, well, it is 15 minutes over our time, but I would have been remiss if we didn't take advantage of Sabeth's lens into the marketplace, given his prior and current roles. So if you have questions, and it's very difficult live to try to respond to them, I try to incorporate some of the commentary in, but if you have any questions, please email me. I will circulate them and we'll get back to you. The idea of looking at risk and looking at the market right now, and there's so many, this kind of multi-dimensional chess game that's going on between all of the different asset types and the markets and the regulation and the liquidity being injected and oversight on what you can or can't do with your business, and that depends on what state you're in and where taxation is going to go after all, especially around real estate markets. Does it become too expensive to be in New York at some point, and do people start to leave because of that, especially given what we've experienced in terms of working remotely? So if anything, this should leave everyone with some answers, but probably even more questions. And this is not a simple, this is not a 1 hour discussion to talk about risk in the context of the current market. But I want to thank William for your insight and your time. Sabeth, thank you for joining us and for sharing your insight. Please email with any questions you have. I appreciate you joining us today for this event. And again, thank you for supporting NYU.